Hello and welcome. My name is Wessam Alankar, and I am the founder and CEO of Hyventic AI. Thank you for joining us today. In US, industrials, returns over the next quarter will be set less by demand and more by financing and policy. Before the FOMC, Federal Open Market Committee meeting will be on September 16th, 2025, we will discuss this playbook that converts those signals into board-gated actions and investor-grade evidence, so you can defend margins now and scale recurring platforms the moment conditions allow. Treat 4 external dials as decision inputs, not backdrop. Tariffs and duties, technology and export controls, foreign investment reviews, and conflict-driven route premia. These determine price architecture, supplier choices, and cash velocity. Inside the enterprise, we measure capacity to act with Accenture's Enterprise Resilience Index, ERI, tiles like liquidity coverage ratio, LCR, lead time coefficient of variation, CV, supplier concentration, perfect order rate, and pricing power. Artificial intelligence decisions are governed under McKinsey's Responsible AI, RAI controls, bias and robustness tests, explainability, telemetry, and incident response. Externally, Boston Consulting Group Policy and Trade Analytics provide corridor, duty, cost, and risk evidence. Kearney's Reshoring Index, KRI, Resiliency Compass, and Resilience Stress Test, RST, show where dual sourcing, automation, and alternates pay back. As of early September, market stability and economic trust is amber and business resilience position is strong. That places US. Industrials and geopolitical resilience quadrant 3, defend and maintain margins. The mandate, keep continuity overlays on and prepare to pivot into optimization if financing eases. First, working capital and footprint efficiency, compress cash cycles, simplify nodes, instrument flow automation, target sub-24-month paybacks. Second, selective automation and near-friend shoring, dual qualify critical parts, stand up trusted corridor capacity, and harden lane visibility. Speed is governed by the switchboard, simple gates with thresholds, persistence windows, and owners. Gate A, deepen margin defense. If LCR trends at or below 1.5 and financing tiles stay amber for 2 intervals, tighten price mix and shift to variable capacity contracts. Owners, Chief Financial Officer and Chief Risk Officer. Gate B, accelerate automation and near-friend shoring. If lead time CV is 0.25 or higher or supplier concentration is 40% or higher with policy friction, execute automation and dual sourcing. Owners, Chief Operating Officer, Chief Information Officer, Chief Information Security Officer. Gate C, begin rebuild and optimize. If LCR is 1.7 or higher and change in weighted average cost of capital from RAI governance, DW-AI, is minus 25 basis points or lower for 2 intervals, scale working capital and price mix resets. Owners, Chief Executive Officer and Chief Financial Officer. Operators, Eaton, Hubble, Envent, Jabil, Flex, Aptiv, Lear, Caterpillar, Deere, and United Parcel Service, Greenlight, cash and cycle time sprints, dual qualify semiconductors and printed circuit board assemblies, and stand-up friendshore cells. Pre-authorize installed base platforms and recurring service to scale if financing eases and lanes stabilize. Investors, overweight names that can show service reliability and cash conversion under audited models. Market perform cyclicals with buffers. Avoid single-lane exposures until continuity improves. Disclose today versus scenario bridges using Wall Street Artificial Intelligence Resilience, AIR, overlays, DOAC-RAI, expected cost of AI incidents, AI liquidity, value at risk at the 99% level, resilience quality adjustment to the multiple, and change in option-adjusted credit spread, tied back to ERI tiles, RAI controls, Kearney execution metrics, and BCG policy and trade evidence. Let's set a short control tower review, your live thresholds, your next plays, and the first 90-day sprints, so you defend margins now and scale the moment policy and financing allow.